Holy flippity flip flop flap and smokes, everyone. We have just got a new inflation report, and all the experts were saying inflation was going to go away. They were saying the Federal Reserve's going to slow their interest rate increases and everything's going to be fine. Well, people, no, it's not going to be fine. The exact opposite is now happening. Inflation is still getting worse. The Federal Reserve is going to have to get much more aggressive. We've just got some new data that came out today, and people, you need to know what this new data is telling us, and you need to know what consequences this is going to have for the market, because as I'm recording this, it's looking like it's going to be a very bloody day on Wall Street. So everyone, let's not waste any time. Let's get into the news, the facts, and the data. Now this headline here, everyone, is very deceptive. They say inflation just rose 0.1% in August, even when there was a sharp drop in gas prices. And I'll get into a moment why there has been a sharp drop in gas prices and why gas prices after November the 8th are about to skyrocket yet again. Now what you have to know is there's the headline CPI number, and then there's something called core or core inflation. That's excluding energy and food, which can be very volatile. And the Federal Reserve actually pays more attention to core inflation, because if core inflation is high, then that means inflation is more entrenched and it's more broad, which also means it's much harder to stop. And look what happened with core inflation, everyone. This is why the markets are so worried right now, why they're shaking their boots, and why the markets could be about to sell off very heavily today. Listen to this. Excluding volatile food and energy costs, CPI rose 0.6% from July and 6.3% from the same month in 2021. Now, for those of you that don't know much about inflation or core inflation and all this economic jargon, to put it simply, why this is so bad is this core inflation is double what the markets expected. They expected core inflation of 0.3%. It was double that, 0.6%. So this is showing it's not just energy and food that's causing this inflation crisis. Everything is going up. And why this is so bad for the stock market, cryptocurrency, and real estate is because that means the Federal Reserve is going to have to get much more aggressive. And there's even calls now, which I'll get into in a moment, how some people are saying the Federal Reserve needs to lift interest rates by 1% at their meeting this month. So energy prices fell 5% for the month, led by a 10.6% slide in the gasoline index. However, those declines were offset by increases elsewhere. Now let me show you a chart why gas prices are falling so much and why they may be about to reverse late this year. Well, look at this chart, everyone. This is a chart of the US strategic oil reserves. And what we can see here, since 2020 and more specifically 2021, they've been draining these reserves. And there's a lot of speculation they're doing this because the midterms are due in November. And so obviously the current administration wants the stock market to be looking good. They want the economy to be looking good. And they want to come out and say they beat inflation. After November, once these oil reserves get so low, they're going to have to start stocking up on these oil reserves again. More demand, not enough supply. Oil prices and gas prices are going to start surging again. But unfortunately, something that's very essential for American families, and this is happening around the world, is food. And food is still going up at a rapid pace. The food index increased 0.8% in August, and shelter costs, which make up about 1/3% of the weight in the CPI, jumped 0.7% and are up 6.2% from a year ago. Now, I think we can all agree real inflation is much higher than this. But even still, if you annualize the rate of which food prices are going up, that's 9.6%. And the reason why CPI isn't as high as it should be is because they are saying rents are only increasing 0.7%. But we know there's many areas, cities, where rents are going up 20 to 40%. And it's rents that make up such a big weight in the CPI, that's why it's dragging it down. But with rent prices going up recently, I think this is going to lead to CPI keep on being hot, and it's going to be more trouble for the markets. Let's have a deeper look why. Look at this. Stocks are heading for a big drop after a red hot inflation report, and S&P 500 futures have lost more than 2%. And if we also have a look here at the Dow futures, the Dow is down nearly 600 points. And will this get worse at the open? Will the dip buyers come in? Will the plunge protection team come in? Only time will tell. And the market now prices in bigger than 75 basis point hike for the next week. The traders are betting the August inflation report will force the Federal Reserve to be more aggressive in the near and longer term with its interest rate hikes. Now, some investors are thinking a 1% point rate hike is possible. And people, I think the Federal Reserve has to lift interest rates by 1% at their meeting this month. Whether or not they will, they probably won't do it, but I think they have to do it. Because for the past year, they've been behind the curve. They've gone from 0.25% in hikes to half percentage point hikes to 0.75 percentage rate hikes, and it's not doing the job. It is not good enough. So why are they waiting to get interest rates to 4%? why they're taking their time. Why not just get to 4% right now? They need to get this inflation under control before it gets worse. But no, they're dragging their feet. They're taking their time because they know once interest rates go above 4%, we're going to see a great recession that could lead to a Great Depression because of so much debt that is in the system. And now look how high investors are thinking that interest rates are going to go. So investor expectations of what interest rates will go to exploded to 4.19% or 4.25%. It was 3.99% before the CPI report. And what have we seen for the past 6 months? We've seen investors expect the Federal Reserve will go to 2.5% and then they'll stop. Then they said, okay, 3%, then they'll stop. 3.5%, then they'll stop. 4%, then they'll stop. Now it's 4.25%. I think we all know there's no way you can stop 8-9% inflation with an interest rate of 3 or 4%. Normally what they've had to do throughout history is bring interest rates to match inflation or above inflation. And I think this is why the markets are so terrified right now, because they may think this is going to be the reality to get the job done. Because look what's happening with interest rates on the 10-year US Treasury now. The 10-year US Treasury yield skyrocketed from around 3.2% to 3.448%. And people, what this means for the housing market, we're going to see mortgage rates go much higher. I don't think Treasury yields are going to stop at 3.4%. I think we are going to see Treasury yields at above 4% either late this year or early next year. And what that means is mortgage rates are going to go to 7%. And with mortgages going from 2.6 to 7%, it is just simple math, simple economics. This housing market is going to have to crash. And this bear market we've seen in stocks, it's going to have to go much lower. And remember, the average bear market is a decline of 35%. And we aren't even down 20% with the S&P 500 right now. And what's happened over the past few days is the market has had these slight increases of people hoping, crossing their fingers and praying that inflation will come down and that they'd try to time the market. But unfortunately, the markets have punished these people now. And really the only reason why the market's been going up the past few days is because of short squeezes and forced buying. Look at this. Forced buying puts a floor under stocks nobody else wants to own. Short sellers, option hedges, quants seen driving an up week. Retail and fund outflows show growing risk aversion amid Fed. So what this simply means is people that have been shorting the market, while there's been a squeeze, they've had to buy stocks that they don't really want to own to cover their short positions. And what's unfortunate is people like myself try to warn people of what's going to happen over a 6 to 12 month time frame. And the market goes up for 1, 2, 3 days and people all of a sudden think, okay, it's time to go all in. They FOMO in, they buy in only to get wrecked when the market reverses. People, you have to have patience. If the fundamentals don't change your investing strategy just because you see the market going up. Because it's not just the Federal Reserve which is going to be trouble for markets right now. We have some real issues in the economy. We have mass layoffs coming. We have banks losing billions of dollars in revenue, and I'll show you that right now. So look at this. Goldman Sachs to kick off Wall Street layoff season with hundreds of job cuts this month. And why could they be doing that, everyone? Look at this. US banks lost a record $370 billion in deposits last quarter. Hello, are you starting to get the picture here, people? This is a train wreck, but it's happening in slow motion. But when you look back on times like the Great Depression, it seems like it happens very quickly. But once you're living through it, it actually goes very slowly. Same like 2008. When you look back at 2008, people think it just happened overnight or over a few months. No, these things take years to play out. So while we are in a bear market now, why are people saying the crash hasn't come or the housing market hasn't crashed? Because they don't understand these things take time to play out. So you have to be patient. And if we look at Bitcoin here, we can see as soon as this report came out, we saw a huge red candle and Bitcoin dropped from around 22,700 and it's now down to 21,300. So I know what you're thinking. Okay, what does all this economic jargon, what does all this Fed talk mean for you in simple terms? What this means, everyone, this is only the beginning. Like I'm harping on about, but I have to keep on reiterating. This is only the beginning. We are not close to what the Federal Reserve interest rate is going to have to be to bring down this inflation. And even once they stop lifting interest rates are going to stay at that 4 to 5% level for some time. And that's going to cause huge economic pain. That's going to cause defaults, bankruptcies. We're going to see a huge wealth effect. We're going to see huge amounts of American wealth wiped out. We just got a report, which I showed you in my last video. $6 trillion of US household wealth was wiped out in the second quarter. We are starting to see the early stages of layoffs. We are in a technical recession with 2 negative quarters of GDP, but still many people are unaware of how bad it really is. So everyone, it is time to buckle up because it's going to be a very bumpy ride going ahead. But everyone, what do you think? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.